We're all told that we need to invest more for retirement, but how do we actually know what that will translate into? There's a few calculators out there, but they're pretty vague and they don't really allow enough tailoring. So in this video, I'll give you a framework that will help you to calculate how much you need to be investing. I'm going to keep it fairly conservative. There's always comments on these types of videos saying it's not realistic or it's too clickbaity. So if I lean more towards the lower end, then hopefully your situation is better. I'm going to use a £60,000 salary at 30 years old as an example, but with all of these figures, you can adapt it to your personal situation. So that's a gross monthly salary of £5,000 per month. And this is where the conservative bit comes in, because I'm going to say that I want that level of income adjusted for inflation in retirement without including the state pension. I don't just want this level of income to be what we need to get by. Hopefully this means that we can live a little too. It's conservative because hopefully you would have paid off your mortgage. You'll now be withdrawing rather than contributing to your investments. You may have other income sources. And as we'll come on to, your tax situation will be much more forgiving. First, we need to calculate what the total amount invested we need. And this is where withdrawal rates come in. To get an annual income of £60,000 per year adjusted for inflation, at a 4% withdrawal rate, we would need a pot of 1.5 million. If we used a 5% withdrawal rate, we would need slightly less at 1.2 million. I'm focusing on drawdown just for flexibility, but you could potentially get similar rates with an annuity. There's just so many more factors to consider there. Now let's have a look at what we would need to invest regularly to hit these amounts, and then we'll have a look at what this will actually cost you in reality. I'm going to use a 7% annual growth rate. This is based on the average stock market returns of 9 to 10%, minus about 2 to 3% for inflation. On a more recent basis, stock market returns have been slightly higher, but this is just going to be safer. So on this basis, if you're able to invest £1,000 per month, it would take around 30 years to hit more or less what you need. This also factors in around a 2% pay rise each year. So in our example, someone at age 30 could potentially have this amount by the time they're 60. But to get to that £1,000 per month, it wouldn't actually cost you that much if you used a pension due to tax relief and potential employer contributions. To work out what we need to contribute to the pension, I'm going to use a net pay arrangement. This is where our pension contributions are taken before income tax. So your tax relief is whatever your marginal tax rate is. So in the case of a £60,000 salary, that would be 40%. If you're able to use salary sacrifice, then you'd also save on national insurance, even with the recent changes. Let's say that we can contribute 5% to our pension. Most employers will match this. The minimum they have to contribute is 3%, but it can be far more generous. At a previous asset manager I worked at, they actually contributed 10% as a baseline, and then on top of that, they matched what you contributed. So I was contributing 5%, but getting 20% into my pension. So in this example, I'm simply going to say that the employer is going to match the 5% that we contribute. So that would be £250 going in from us, and then another £250 in from the employer. But this wouldn't actually cost you £250. It would in fact only cost you £150. This is because 40% of that contribution would be tax relief. On this calculator, it does say the tax relief is only £50, but that's because it's using relief at source. That's where the pension provider would claim 20% on your behalf, and then you would have to claim the other 20% if you're a higher rate taxpayer via your tax return. But if you use a net pay arrangement, this is done all for you, so you haven't got to worry about that. You would still get the full 40% without doing anything else. So now all of a sudden that £1,000 per month doesn't seem quite so optimistic. For the cost of £150, we're getting half of that through our pension. The other half, so £500, is what we would then have to invest separately into something like a stocks and shares ISA. That isn't necessarily easy on a 60k salary, but it's definitely achievable. I've set the increase in contributions to 2%, and that assumes that if you get a 2% pay rise each year, you're able to then put that 2% into these contributions. But I actually think that's quite conservative because depending on your industry and how much you're willing to move around, your annual pay rises could be a lot more than that. Remember as well that when you come to draw that income, anything from your ISA is going to be completely tax-free. And from your pension, you'll get 25% tax-free, up to the cap of £268,275. So although investment pots over £1 million does seem very ambitious, depending on your time horizon, it is very achievable. There may of course be policy changes in the future, but you have no control over that. The best thing you can do is to have a good balance between investments into your pension and into your ISA. You'll get the tax relief and hopefully employer contributions with your pension, but you also get the flexibility that comes with the ISA. If you're struggling with choosing the right investments and you want to simplify your approach, I have a free ETF cheat sheet you can download that compares various ETFs across different regions and sectors. It makes it really easy to compare. It's linked down below. The biggest driver for your investments is time and staying consistent. The framework that I've shared in this video is not going to be perfect for everyone, but you can adapt it. You may have a shorter time horizon, but you're able to contribute more. Or you may expect a different rate of return. But either way, it gives you an idea of what level of income you can expect from your current contributions. And then from there, you can decide whether you need to adjust course. If you're wondering whether you'd be better off using drawdown or an annuity, then watch this video next. I hope you found that useful. Thanks for watching.